Good afternoon. Thank you, Kate. And as I was saying, I wanted to start off by congratulating Ajay and George on their research work. It was awfully extensive. Certainly, my roots are not in the quantitative analysis, regression, and a lot of the statistics they put there, but the content of the message was clear. And so I enjoyed reading that. It's pretty fortuitous when you think about where we are today and the uncertainty, what lies ahead, to be reminded of some of the consequences of behavior. And I think that's kind of really the message that I want to go across and speak to today. I would start by saying that in both conclusions of the papers, I would agree. I think to assert that moral hazard provides any safety net to making riskier decisions would be a shortfall in thinking through the strategic nature of a bank. And certainly the impact of higher cost of doing business through assessments plays right to the bottom line of an institution. So you cannot ignore what we're talking about today, and we need to keep that in mind as we go out and organize our industry. You know, one might think why I'm involved, and of course I will tell you that I know that the Commissioner of Banking and the Deputy Commissioner of Supervision are listening to this today. I was asked because several years ago, after about 35 years in banking, I chose to work in an area that most people would not jump into, and that is to distress banks. So I have lived it firsthand. So I will speak to some of that with regards to kind of feet on the ground and what it means as you work through deleveraging or leveraging, or do you think you can grow yourself out of problems? And what does it mean to have the impact of the cost of doing business that's not singularly just in the assessment? But I would like to digress just a minute and just remind everybody that, you know, this is about our corporate consciousness. I mean, you know, I don't think, and I would say very clearly, bankers are not making decisions based on everything we've just talked about. It is a part of our process, but it is not what we do in making decisions before we go about doing business. You know, whether it be distressed or non-distressed institutions. It's all about behavior, and I think that's the outcome of both these papers and the influences of what the decisions are, is how do we treat behavior? You know, it's the proverbial three-legged stool. You know, the way I look at it in a normal environment, outside of the core mission and objectives of an institution, as an executive officer, my focus along with my board is all about shareholder value. Outside of that, I've got to work within a regulatory framework. Obviously, we're in one of the most highly regulated industries, and that helps to set the four corners of where we operate. And then certainly the last is what I would consider to be market presence, you know, the long-term aspect of where we are, not just where we are tomorrow. And it's kind of under the umbrella of those three things in our behavior and creating shareholder value, regulatory framework, and our market presence that we go about doing our business. However, when we become distressed, there's a lot of disruption in that order. You know, we find ourselves moving into survival mode. And survival mode is much different outside of the ordinary run. We go from growth, profitabilities, dividends, and building value in an institution to basic survival. That's capital preservation, core earnings, and the ability to remove problem assets off the bank. And without doing that, you will not survive. You know, I'm happy to say that I happen to be in an institution that found itself in a very unpleasant situation a number of years ago. And through a combination of good management and directorship, our partnership, quite frankly, with our regulators, and our ability to have a little luck, we survived and came out of that. And over the last several years are back to growing and profiting from that standpoint. But, you know, getting past that and thinking about what these papers represented to us in terms of what we do and how we go about our business, I think about it in terms of, you know, risk. You know, we are in the risk business. There is no influence to me that's going to subsidize making good decisions, but there's a certain amount of risk that I've got to accept. In the purest definition of the moral hazard concept, I would never suggest that by being able to augment, supplement, overlay something that would tend to mitigate what appears to be risk, that it is the pure substitution for what we do in going about doing our business. So from that perspective, I would never, ever advocate that you are going to grow your way out of problems as a distressed institution. It's just not going to happen. And so in the paper that Ajay talked about, I think, the practical matter from my perspective was to always deleverage the bank, continue to have capital preservation and focus on that core earnings that I talked about. Because even though it was costing you in other areas of the operations, if you had the core earnings, it would help to supplement that. And if you had the capital that was being preserved, it gave you that's the safety net you had, along with some comfort for the oversight that you were facing with regulators, that even if you stumped your toe in the short term a little bit, you probably were going to survive. I will speak a little bit to the assessment side of it. I went back and looked, and this institution went through an immense change in its asset makeup and its size. We basically shrunk the bank down to about half the size it was at the beginnings of the problem. We have returned to essentially the same size in a much different asset category and risk assessment. I say that to tell you that the cost of doing business in a stressful situation as a stressed institution versus today was 5.5 times the cost of what we're paying today in our FDIC assessment. You take that along with D&O insurance and other costs to deal with problems, it does affect that ROA and ROE from that perspective. If you cannot look at that as a behavioral enhancement to how you ought to do business and how you're doing it, then you're probably in the wrong business to begin with. But I do think that characterized throughout the papers was the fact that regulatory oversight, the framework of what we've done to create a safety net through guidance, certainly plays well in the understanding of what we need to do to get from here to where we're going. No doubt when we looked at two different papers between the time frames of the S&L crisis versus the global financial crisis, with the institution of fiducia, the risk to the prompt corrective actions that took place, oversight of Dodd-Frank, certainly restrictions such as 337.6 in the FDIC with interest rate caps, those kind of things are things you don't want to have to face. So you want to deal in a framework that allows you to remain a healthy institution. So the things that I think were presented in both papers are clearly, I think, indicators and supports behavioral decisions that you make when you're a distressed institution.
All right, David, thank you so much for those very helpful comments. It was a nice from the ground view of what, again, I think are two wonderful papers. And actually, you framed it so nicely that my first comment to both is going to grow right out of effectively one of the themes in David's comments. And that is, banks are in the business of taking risks, right? So what we have to figure out, what you want to figure out is if you're mitigating moral hazard or overly reducing risk-taking or adequately reducing moral hazard, is you need a baseline. And neither of you have a baseline. And I don't think that's bad, but I think both papers would benefit from being more explicit about that fact. So let me take that apart a little bit. For George, part of what we're finding, which is, again, such a nice finding, is that there's a meaningful difference in how banks and thrifts were operating during this period. But as you noted, this also really cut in to the profitability of thrifts in a significant way, which also has meaningful long-term effects for bank health. And so one of the things that would be nice to, and you're not going to be able to get there, but just to go back in terms of the framing is, was what we were seeing reducing moral hazard? Well, moral hazard is there's a baseline for the optimal amount of risk aversion, and then there's insurance that's going to deviate it. And if we think all that is happening is mitigating moral hazard, then all we're doing is closing up that wedge. But there's a possibility that we were doing more than closing that wedge, but making it excessively costly to take certain types of risks. And I'm not sure exactly how that ends up playing out, but just in terms of the framing, I wonder if it's just about moral hazard or if what you really are showing is there's the ability to reduce risk taken. That might be mitigating moral hazard, but might be doing other things. And then it goes back to my core point that you're still not actually getting the type of discipline that you would from depositors. So it's still a different mechanism that's going to be at play. All right, more for you in a second. Ajay, similarly in terms of the baseline, one of the things that you're finding is you're saying, look, it looks like they're doing a lot of things that we'd want them to be doing. They're shrinking on both sides of their balance sheet, they're deleveraging. On the other hand, part of the way you conclude that you've successfully identified the right banks as distressed banks is that within a 3-year period, they are failing at a much higher rate, than any regulator would want to see. So it may well be that they are reducing their risk somewhat, but whether that's what they would be reducing in the absence of certain incentives to take risks, we still don't know, as far as I can tell from your paper. So what we're seeing is maybe they aren't doing as much risk assumption as the most extreme versions of the theory might suggest. On the other hand, that doesn't necessarily mean that they're not being affected by moral hazard, because it may well be that given how distressed they already are, they actually should be deleveraging and reducing risk at a far faster pace than what you're finding. Ajay, following up with you for a second, I love the paper, and I just feel like I keep wanting more granularity from it to know what to do with your findings. There's a number, so just following up on what I just said, the whole time right now with your framing, you're generally assuming that the banks are making these decisions. And based on David's comment, that might well be the case. But it could be that they're making these decisions because they have no other choice. And I'm surprised that you didn't spend more time. I don't even think you cited the piece by Virel Acharya and Natamura in the Journal of Finance. I think it was in 2014 or so. But I mean, they are finding that bank depositors are fleeing from distressed banks. So it could be that the reason they're deleveraging is not that they're making a choice to deleverage, it's that depositors are running away. And similarly, they're finding that those banks have significant liquidity constraints that really could limit their ability to make new loans on the asset side of their balance sheet. Which again is not inconsistent with what you're saying, but it'd be nice to know a little more what is actually driving the effects that you're seeing. And right now you're fairly explicit about the fact that it might be regulators coming in. You're less explicit about the fact that they might lack the liquidity to make new loans. And one of the reasons might be depositors are running away. Similarly, one thing, just comparing a little more deeply with that paper as an example of where a more granular cut could be helpful, there, contrary to your finding, they found that distressed banks, which they do define differently, really do pay a premium for deposits. But there they say really what a distressed bank wants are not runnable deposits. They want deposits that are going to have to stick around. So where they really find the premium, where they're focusing, is on CDs. And they do see a real premium there. So I just wonder if that type of more granular look might be helpful. And part of the reasons I'm wondering whether more granular might be helpful is you do have some findings or non-findings that are hard for me to understand what to make of. So as you noted, you do see a reduction in risk right in the first period after fiducia is adopted, but there's nothing in the second period. And you would have expected an effect in both those periods if it was fiducia that was driving it, given the starting point for the banks that you're looking at. Similarly, you find no effect for Dodd-Frank, and just given the amount of additional capital the banks were going to be required to hold after Dodd-Frank, the lack of any effect just, again, seems a little surprising to me. You're looking at, banks that are closely held versus banks that have diffuse shareholder bases. And again, there's no difference between the two. Again, given the moral hazard dynamics and the decision-making within banks, and those are different types of institutions that operate so differently that the fact that we're seeing no difference, again, just raises a flag for me. And so none of it is to say that your findings at this point are not really interesting, but I kept wanting a deeper dive. I mean, one of the things I noticed that was statistically significant throughout almost was the state level unemployment rate and state incomes. So I kind of felt like, okay, well, what's going on here on a regional basis? Like, can we do a deeper dive in a particular geographical area to get a better understanding of what's going on? Or maybe rather than controlling for size, can you break the banks up into communities, regionals, and the large banks? And maybe we're seeing different dynamics across those different size banks. But I feel like right now it's incredibly interesting. It's incredibly rich. But in part because the framing is there's so many different theories pulling different ways, and because you're just in the reality of the difficult situation where you're never going to have a baseline, I wanted to be able to know more about where to go with it. More to say, but I realize I'm running short on time. So just two quick additional comments for George. And again, I like this because it's narrow, it's clean. The the baseline is a small problem, but that really is only a question of framing. The two policy issues that do come out of it is the whole reason we have this natural experiment is because even though we say we use risk-based pricing as a way of mitigating moral hazard, really oftentimes what we're doing in pricing deposits and whether at a particular point in time is figuring how much money a particular insurance fund needs. And I mean, aren't you really saying that if we want this to work, that should have zero role in determining insurance premia at any given period of time? We should just be figuring out the moral hazard, how big that wedge is and how much we can mitigate it, rather than having to think about this other consideration, which is just how big the fund is. And second, I loved and was not surprised that many of the distortions you found came because they shifted funding to the Federal Home Loan Banks. I never go out to study the Federal Home Loan Banks, but if you're interested in distortions around what banks are doing or even markets are doing, you keep going there. You know, so if we looked at the early phase of the crisis, all of the distressed foreign banks were going to TAF. It looked like the local banks had domestic banks had liquidity they need. We know with hindsight, they were running to the Federal Home Loan Banks. Liquidity coverage ratio, banks were running the Federal Home Loan Banks, and it changed who was going to the Federal Home Loan Banks. Money market mutual funds, we tried to reform them. Guess what? Like the prime funds all became government funds. Federal Home Loan Banks stepped in and provided all that short-term liquidity. So, I mean, as part of your call, really, or I don't know if you're going to want to go there, about needing to control other distortions is not just having the right oversight in place, but we have this like chronic distortionary force. So I would personally love if you'd be willing to go out on a line at some point and say a little bit more about the Federal Home Loan Bank system.